Welcome to the Deep Dive. We're your shortcut to understanding some pretty complex global shifts. And today, wow, we're diving headfirst into quite a bombshell accusation coming out of Russia.
Yeah, it's from Anton Kopikov, who's a special advisor to Vladimir Putin.
Right, and he's claiming the U.S. is trying to use stablecoins to devalue its huge $35 trillion debt.
And not just that, but potentially reset the entire global financial system in the process.
Exactly. So our mission today is to really unpack this. We'll look at the mechanics, what this could mean for traditional banks.
And crucially is where something like Bitcoin fits into this
Yeah.
very high-stakes financial game.
We want this deep dive to give you that shortcut, that understanding of what could be a massive shift happening right now.
Okay, so let's start with that Russian perspective. Kobikov's accusation is basically that the U.S. is, quote, weaponizing crypto.
Weaponizing crypto, strong words.
Yeah, and the idea is they're using it to export their debt problem, make it the world's problem, essentially devaluing it that way.
It sounds politically charged, obviously, but you mentioned mechanics. Is there like a technical basis to this claim?
Well, that's what's fascinating. The mechanics they seem to be pointing at line up quite well with this proposed U.S. legislation, the Genius Act.
The Genius Act, right. The first potential federal crypto law.
Exactly. And it mandates that stablecoins, the U.S.-issued ones anyway, must be backed one-to-one by U.S. Treasuries with full audits.
Okay, so connect the dots for us. How does that backing requirement play into Russia's accusation?
Well, think about it. Every new digital dollar created by a U.S. stablecoin issuer requires them to buy a dollar's worth of U.S. government debt, like Treasuries.
Ah, okay. So it creates an automatic buyer base for U.S. debt.
Precisely. So the U.S. has found a way, maybe quite ingeniously, maybe subtly, to basically increase global demand for its treasuries. The mechanics aren't wrong.
Subtle, or maybe like a Trojan horse. I know that term's being thrown around.
That's a good way to put it. And it's not just proponents saying this, even critics, like Cornell professor Dave Collum, who's known for being skeptical of Bitcoin.
Right.
Even he acknowledges that stablecoins are effectively creating this pipeline, a pipeline funneling global demand straight into U.S. treasuries. He sees the strategy.
So, okay, if the strategy is visible even to skeptics, what's the deeper game theory here? You mentioned Eric Yakes' perspective earlier.
Yeah, Yakes points out something really key. These stablecoins are kind of bypassing the traditional banking system, right? Central banks, commercial banks. They're going directly to buy government debt.
Cutting out the middleman.
Exactly. But here's the twist, the paradox in the Genius Act. While it sets up this framework, it also seems to deliberately make these U.S.-regulated stablecoins less attractive.
How so? Less attractive.
Well, it forbids them from paying interest,
Mhm.
and it limits their reserves only to short-term government debt. Think T-bills.
Okay, no interest in restricted reserves. That doesn't sound very competitive, especially globally.
It's not. And Yakes argues this is almost by design. It creates a huge incentive for an offshore stablecoin market to flourish.
Ah, because the offshore ones can offer interest.
They can offer interest, and they can hold more diverse, potentially higher-yielding reserve assets, not just short-term U.S. debt.
So competition heats up offshore for the best yield.
Precisely. And as that competition for yield intensifies, where do stablecoin issuers naturally look for better reserves? They'll gravitate towards harder, more profitable assets.
And this is where Bitcoin comes back into the picture.
This is exactly where Bitcoin comes in. We already see Tether, a major offshore player, holding about 5% of its reserves in Bitcoin.
Okay, 5% is a start.
But Yakes projects this could realistically grow to 50%, maybe even more over time. Why? Because Bitcoin has those, superior monetary properties, scarcity, resistance to inflation, plus its potential for value appreciation. It's a harder reserve asset.
50% or more, that's a massive shift. But wouldn't traditional finance and governments push back hard against that?
Oh, absolutely. There will be pushback. But the argument is that the market's relentless demand for yield, especially in this offshore competitive space, might just overpower that resistance.
So that's the Trojan horse. Stablecoins get the world used to crypto infrastructure, but the underlying competition for yield inadvertently drives demand towards Bitcoin as the ultimate reserve asset.
That's the theory, yeah. It accelerates global Bitcoin adoption almost as a side effect of trying to manage government debt.
Okay, let's pivot to the current market. Are we seeing signals that kind of back this up?
Well, look at Bitcoin's resilience.
Yeah.
We just saw a huge whale sell-off, right?
Right.
$12.7 billion, the biggest since 2022.
Yeah, massive selling pressure.
And yet Bitcoin is holding remarkably strong, staying above $110,000.
Yeah,
That tells you something about the underlying demand or HO dealing sentiment.
Incredible resilience, absolutely. What else?
Then you've got Morgan Stanley now forecasting continuous rate cuts all the way through 2026.
Which means more liquidity flooding the system.
Exactly. More liquidity looking for a home, looking for yield. And don't forget gold,
Right, gold hitting new all-time highs.
which signals, a broader unease with traditional debt-based money. It expands the whole market for stores of value.
And how does Bitcoin look relative to gold in this environment?
Well, if you measure Bitcoin against gold, some analysts see it potentially poised for another big rally, maybe 300%, targeting somewhere like $167,000 to $185,000.
Wow. So putting it all together, massive sell-off absorbed, rate cuts expected, gold surging.
Paints a picture, doesn't it? It feels like the market is signaling a significant shift, maybe away from traditional debt instruments towards harder assets.
So wrapping this up then, stablecoins might seem like a clever fix for governments in the short term.
A temporary bandage, perhaps.
But the fundamental laws of money, that search for sound value and yield, you can't really change those. The free market, especially that competitive offshore market, will likely keep pushing reserves towards assets like Bitcoin.
That's the core idea of the game theory playing out.
Yeah. So, the final thought for you, the listener. What do you make of all this? Is Russia onto something about U.S. intentions? Do you buy into this Trojan horse theory where stablecoins accidentally pave the way for Bitcoin?
And maybe the biggest question, how much of this complex interplay do you think governments and the big banks actually understand right now? Lots to chew on there.